In order to do the financial statement analysis, what do we need? We need the financial statements, obviously. For what purpose we're doing the analysis? Obviously, to check the performance of the company. Which statements we're going to look at? Those will be the statement of financial position, statement of income, statement of cash flows, statement of changes in equity, notes to financial statements. That's going to give us how healthy the company is, what's the cash flow, what's the efficiency, and all other things that we need to find out about the company. I told you in the class that I'm going to explore this opportunity here with Cedar. So let's see. I'm going to show you now with what's happening here with the Cedar. What I want you to do, if you want to follow me, just open one um, internet browser. And once you have that internet browser, what you have to do is just put that Cedar plus there, and you're going to find the Cedar plus landing page. Once you click on it, you're going to see some person that wants to do some financial analysis, ideally. Let's go and search. Here we can find all the public disclosure documents. So if you want to know more about it, what's that Cedar Plus about, you can click on the Cedar Plus on the bottom, and you're going to find out that the Cedar is continuation of Cedar Plus is continuation of the Cedar, which is under Canadian security regulations. What that means is that all the publicly listed companies in Canada have to post their financial statements here. You're going to see what's about the website, what they have to do, users, organizations, profiles, filing, fees, payments, refunds, everything that you need to know if you want to post on Cedar. That's not our objective. Let's go and check the companies now. If we click search Cedar, let's see what we're going to have. And we're going to come something like this. And we're going to start with, I try in the morning. Let's see again, if this is going to come up with companies. Rogers to communication. No, Rogers communication. Let's see what other options we have here for the Rogers. Let's see how many companies we have. Rogers communication. I'm going to stop on this one. Let's see if I choose the right company here. So once we click on this one, we're going to click search and Rogers Communication. Let's click on this company. And we're going to find out when the company, no, that's not the one that, let's see if that's the one. No, I don't like this one. Let's start again. Let's clear the search criteria and let's start again. I had the same problem in the morning to find something. Trying to find the right company so you can actually see the reports and everything. It should be this one, but I don't know why. Show. Let's try again with this one. So those are the documents which this company posted. You can see here a lot of documents. They have interim financial statements in French and in English, new releases, interim financial statements in English again. You can download any of those documents. You have this management discussion and analysis report in French, management information circular all the different documents that you may need. Interim financial statements, that's as of in French, in English, as of April 24th. That means those will be for the first quarter, I guess, but that will be my guess. Auditors, consent letter, if there's any auditors, any communication with the auditors, any meetings, any available information which they think that's important for the readers or for the investors, it's here. The one that I want to show you is a management discussion analysis report first. I'm gonna download this one. So let me see what you see. That's not what you see. So let me show you this first. And the other thing that I want you to see is the financial reports, but English version, annual reports, this one. Okay, so let's go now. I'm gonna do new sharing so you can see what I actually downloaded and how those reports actually look like. First one is the financial statements. This is the financial statements of the company. They're saying that's a record-breaking year, 2023. You see people smiling, everybody's happy, everybody making money, this company making money. That's a message for the shareholders. That's another message here from another person who also smiling. As you can see, all the positive messages are sent from those people who are smiling. Here's the chair of the board of the Rogers Communication. And record-breaking here, record-breaking performance, record-breaking merger, record-breaking innovation, record-breaking employees, record-breaking board of directors. Everybody's breaking the records. Now the question is, what we're going to do next year? If this year we break all the records, what's going to happen 2024? Who knows? But what we can see here of the table of content, you're going to see on which page what you can find. Strategy, key performance division, strategic highlights, comparability, delivery results, financial results. You can see the different consolidated statements of each company, wireless, cable, media, all the divisions of the Rogers. Then you're going to see how they manage liquidity and financial resources. So here we're going to find some financial conditions, financial ratios, risk management, anything that you need to know. Then you're going to see the income taxes, risk management again, regulation in our industry to give you key performance indicators, accounting policy, and everything that the investor needs to know. So all the things that we're learning is basically here. As you can see here now, you can see the total revenue comparison you can make with the last year. If you want to do the trend analysis, you have to download the reports from the 2022. That's going to give you the numbers for 2021. And if you download 2021, then you're going to have 2020, and then you're going to have 4 years in a row. So as you can see, the revenue grows up. And that's not the case with the net income. Revenue grows up with 25% change. That means that's 25%, as you can see, that's related to $4 billion because that's $1 million. $4 billion increase in revenue, which transfer to negative net income from plunging the net income for almost half from what they have. So with the $4 billion increase in the revenue, they're generating almost 50% decrease in their income. So that means something is definitely very wrong with this company. Adjusted net income, now we have adjusted net income. They try to, with the accounting policy, to close the eyes of the investors so they can show that, okay, my revenue increased with 25%, but you see that 25% is increased, 26% increase in the net income. So that's mean those are two consistent, even though the pure net income is going down with 50%. Basic earning per share, right now you can see with $15 billion revenue, your earnings per share is 50% higher than with $19 billion revenue. And keep going, keep going, keep going. Give you the ATS from what's happened with the service, which one is wireless, what the wireless contributes. Wireless give you the service revenue, how much is the revenue, how much is the adjusted earning before interest, taxes, depreciation, and amortization. Cable company, how much revenue they carry, and we have the media, the revenue of the media. If you combine all those things, you're going to get the same. So 10,022 plus 705 plus 2335 should give you that number. That's how we should look the information. And then you can key performance indicators. Here I give you some ideas about it. Key performance indicators. You see you have here some ratios, different ratio that I think that it's important for the investors. But once you have the financial reports, you can start doing your calculation. You can come up with the ratios that you want to find out, not the ratios that they're giving you for you. What else you can find here? Let me scroll down a little bit. And there you go. Now we have summary of consolidated results, revenue by divisions, from where the revenue comes from. That's 19,308 comes from actually from wireless, cable, media, and the same. You have corporate item intercompany eliminations. You have that amount to balance it. Adjusted income before interest, taxes, depreciation, amortization based on everybody. And you can see, and if you keep going, you're gonna start seeing more and more and more information with the changes. Oh, every time when you see the percentage of the changes, that will be horizontal analysis here. Clearly horizontal analysis. Every time when you see sales and everything expressed as a percentage of sales, that's a vertical analysis. And we can keep going. You can see a lot of interesting information. Here you can see the quarterly consolidated financial summary, how each quarter goes. That's for the full year, how that's coming from quarter by quarter. Now, the next thing that I wanted to do to show you is this management. Let me see if you can see it. I believe. Can you see the management? Yes, you can see the management analysis, discussion and analysis. That's the second discussion analysis. That's the next report, which is kind of important. You as a manager to see where this company planning to go. And they're discussing here the risks and uncertainties. Before making investment decision, what's important for more information, where to get the more information. And again, they give you briefly the key financial information here. Key performance indicators, again, repeated in here with the ratios, again, those ratios coming from the financial statements. And you keep going with the cash flow explanation. Share transaction, what they did, they acquired share last year, Rogers. They purchased share. Competition, which is the competition on the wireless market, on the cable market. What's the industry trend in the media and the wireless trend, the cable trend, media trend, everything. Here they're discussing in overall everything that you need to know about the business and about this environment. So you can see it's there a lot of information which is available for you. The question is, are you gonna look for it? Because it's available. That's the funny part. It's available for you. The question is, can you find it? Can you read it? And once you read it, can you interpret it? Obviously, if you know what you, so that's why it's important for you first to determine.
I don't want to be paid with no internet, right?
So the first thing, that's why the first thing is the most important. You to know for what purpose you using this, making this analysis. Is it for the investment purpose? Is it for lending purpose, or what exactly is? Then collect the information that you need for the purpose that you're looking for. Then prepare the common size analysis. Calculate the ratio. Analyze and interpret all the ratio that you have calculated. and develop your recommendation. So based on the context of the financial statements, for different purposes, you can use the different information. Once you get the information about the business, you have to have information and also have to do your research about the activity of the business, which are the risks in industry, what's the economic environment for that business, what's the strategy, what kind of strategy the company using. We're going to see about the strategy next time. Which are the key successful factor which is going to keep this company healthy. Then you're going to find more relevant information from where for the management discussion analysis report, which I just show you. You're going to review all the additional information. You're going to review the financial statements, which we just saw. You saw that there's a auditor's report as well. And the last thing that you have to do, pay close attention to the non-financial statements. Why? Because nobody looking at those statements knows the financial statements. Especially you have to pay attention on the accounting policy of the company, what has been changed, how it has been changed, what they're doing going forward. Analysis that you have to prepare will be the one that you're trying to determine the future results, which is called prospective analysis, and you can use the retrospective analysis as well. What's interesting with the retrospective analysis is that you're using the past information and past event to predict the future. We're going to the trend analysis and the cross-section analysis. The trend analysis is the one that you're doing based on the company itself, but you're looking for the period more than 3 years, up to 10 years or maybe more, depends. Cross-section analysis is when you compare one company to another company. In that case, you have to use the common size information so you can compare company with the company. The raw material, the raw data that you're gonna get, raw material we're gonna see in managerial accounting what is it, but here you need the raw data, financial data, which coming directly from the financial statements, and that is the data that you're gonna use for your analysis. So if you want to compare company within the company with itself, you need to have at least 2 years of data. We saw in our case, you have 5 years, not 2, 5 years. And you see that the revenue goes up. That is directly reflected to the earnings. Earnings in some years goes up, in some years goes down. You see the assets, what's happened with the assets. Assets exponentially increase year after year. Interest bearing debt is also increasing. Shareholders' equity is also increasing. Now, again, common size analysis is the one that converting everything into percentage. How we're going to interpret those percentages depends what you're doing. If we're doing the income statement analysis, you're going expressing everything out of revenue. So as you can see here, first thing is no, actually here doesn't show the gross margin. You're going directly to the net earnings. And once we do that, then in order that's for the common size analysis, if you want to, you're using the company data to compare the company with itself. If you want to compare the company with another company, then you're going to come to the common ratios on the ratio analysis with the common ratios, which are set up in different categories. First, you're going to look at the liquidity ratios and compare company with company, activity ratio, solvency ratio, profitability ratio, and equity analysis ratio. Liquidity ratio, as we remember, as we said in the classroom, refers to the company ability to convert assets into cash in order to pay the current liability. So how fast the company can pay the current liability? You have two measurements here. Current ratio basically measure the proportion of the current assets versus the current liability. The key point here on the current ratio is you to chase at least to be equal to 1. How are we going to get that 1? Only and only when the current assets are equal to current liability. Once the current assets are equal to current liability, current ratio is 1. Obviously, if you want to be more than 1, ratio to be more than 1, then you have to increase the current assets. Has to be more than the current liability. And for less than 1, if you want it less than 1, that means current assets are not enough to cover the current liability, and the current ratio will be less than 1. Again, current ratio is the current assets versus current liability. Quick ratio is basically the cash, or anything that will be super fast converted to cash. For that reason, we excluding the inventory and prepaid expenses. Why those one are excluded? Again, because it takes too many steps to convert inventory into cash. Means you have to sell the inventory, then you have to collect the accounts receivables, and then to have a cash. For that reason, inventory is eliminated. Prepaid expenses, the logic there is the chances you to ask for the insurance that you paid for the entire year on the business that's going to continue operations and you're not planning to close the business, the chances you to ask for that insurance and money back are pretty much zero. For that reason, prepaid expenses are excluded from the calculation of the quick ratio. On the company that we having the information about is that current ratio in this company actually improving. For lower number goes up to the higher number. And we say that we want that number to go high. High as possible is better. Quick ratio, on the other hand, is below 1. That means the company is not too liquid. Means the portion of the inventory and the prepaid expenses compared to the other assets. It's a little bit high. But anyway, 0.70 and that range, and that's not too bad ratio. Let's put it that way. It's not that too bad. The only thing that we can see is the inventory balance increasing slowly increasing. Activity ratios, the ratios that I'm gonna test you next time, and I told you that I want you to know those activity ratios very well. We have accounts receivable turnover, we have inventory turnover, and we have accounts payable turnover. Again, let's go one after another. Accounts receivable turnover simply measures how fast you can collect your accounts receivables, or how fast you can collect your sales that you're selling on credit, or sales that customer doesn't pay you cash at the time of the sale. Do you need to know that ratio? Absolutely. How that's going to help you to calculate how long it's going to take for the customer to pay you. Obviously, it has to be compared with the company credit terms if there's any of those. The idea here is accounts receivable turnover to be as high number as possible. Why is that? Because after that accounts receivable turnover comes as a denominator for the calculation of the average collection period, which nominator is always 365. High number here to 365 means less days to collect. Ideally, you want the bottom number to be close to 365. If the number bottom is 365, then you're collecting your accounts receivable in 1 day. If it's one, only one, that means you're collecting your accounts receivable. It takes you 365 days to collect your accounts receivable. That's how you should interpret these numbers. Now let's see how this company performed. First, the number was high, and then slowly start to getting low. Where that's gonna hit the company? Well, that hit the company directly on the days that they need to collect the accounts receivables. So before they're collecting the sales in 29 days, 30 days, now they're collecting the sales in 33 days. So as you can see here, if we put it at the same spot, so you can see it. If we have low number, that low number transfer in the more days to collect your sales on credit. High number means it takes you less day to collect your accounts receivable. So now, what you have to do, once you get the number and once you get the days, the question is what you're going to do with those days. Well, you have to compare what the business is. What kind of business you're running? And based on what kind of business you're running, you have to ask yourself, is there anything I can do to improve this accounts receivable turnover? And that to reduce the days that takes me to collect my accounts receivables. That's what I need you for. I don't need you to make the calculation. I need you
Professor,
to,
can
yes,
I ask one question?
please.
Like, if you say these things, right? So, when like you have given one question, like, then there you have to find the boundaries on it. Then you said whatever business we need to analyze, right?
Yes.
So, when we are making decisions, on what basis? If the finding account receivable turnover and we are making decisions, then we have to make decision as per that. But if we are finding average collection period, then we have to see that account receivable should be higher, the days turnover. I like how we are going to make decision on that.
Question for you.
Yeah.
You want to invest in the company,
Mm-hmm.
and you see that the company before take them 29 days to collect the accounts receivables. And right now it take them 33, and let's pretend that 24, it takes them 35 days to collect the accounts receivables. Would you
Mm-hmm.
would you like to give them your money?
No,
Why not?
because that collection period is taking longer.
Okay,
I have to collect my money faster. So
right. So the company has to collect their money faster, right? So because if they don't collect their money faster, they might lose those money.
yeah,
Which means for you as an investor, you're never gonna see dividend,
yeah, and we have to pay
right?
others. Yeah.
Or if you are a creditor for this with this company, they're gonna have problem paying you your interest.
So basically, when we are making decisions, so we need to think about this average collection period, not on the base. We are not making the decision on the basis of account receivable turnover, only on the average collection period, right?
Well,
We'll be making
so
decisions.
listen, the accounts receivable turnover
Hmm.
is used to calculate the average collection period,
Yeah.
right? So basically, if you don't make this, either one, it's useful, but if you don't have the accounts receivable turnover, you cannot get the average collection period.
No, I'm talking. Yeah, we'll be getting that. So if our account receivable turnover is higher, then it's good
Yes,
because yeah. So we will making decision on looking on the average collection period, and but if we have good like higher account receivable turnover, then that's best for our business for making decision. Right? We'll be making on that side.
correct.
But that, thank you. Thank you.
Make sense?
That's what I understood now. Otherwise, I was confused.
Right. Okay. So now the question is, from where you're gonna get, in order to calculate accounts receivable, from where you're gonna get create sales? Well, they're going to be given to you. All the sales which are on create or on account means create sales. How are you going to get the average accounts receivables? You're going to calculate the beginning of the year plus the end of the year accounts receivables
And
divided by 2,
divided by two.
and you're getting the average. Simple average. That's nothing scary that. For the accounts average collection period, you're going to have the denominator always going to be 365. Every 3 years, that's going to change to 366. But that's based on the nature of the year. That's for accounts receivables. Now, let's see what's going to happen with inventory. Same idea. In terms of we have to get the number, which number later we're going to use as a denominator, where the numerator is number of the days of the year. We're chasing here with this ratio, we're chasing first how many times we're selling our inventory and how many days takes us to sell that inventory. In order to do that, we need cost of goods sold, or we need the cost of the goods that we're selling during the period. Then we need the average inventory. How are we going to get the average inventory? Same, but average accounts receivable. Beginning balance of the year plus the ending balance of the year divided by 2. Once we get that number, using as a denominator and 365 numerator, and you get the days to sell that inventory. So now let's see with this company that we have in here, there are inventory turnover. Before we continue with that, again, the same thing as accounts receivables. We chasing here high number. Higher to 365 days is less day we have to sell our inventory. If I'm in the bakery industry, and my inventory turnover is 365 out of 365 days, what that means to me?
That you're selling
Yes, it's
everything
good.
within the day.
Well, I'm selling everything in the day. The other thing that means is that people are crazy about my bakery,
That's true.
right? Because if the people are not crazy about my bakery, that's inventory days to sell my inventory is gonna go 5, 6, 7, 8, 9, 10 days. Okay, let's go with this company and see what they're doing. Inventory, as you can see, start going down. The number starts getting smaller. Where that's gonna hit us? Directly increase of the days to sell our inventory. Let's do that comparison so you can see it again. So as you can see, high number 7.3, less days. Low number, more days. Less number, 4.9, more days. You can see only decrease with 1.1 in this number in the inventory, transfer to how many days are those? 15 days, people. 14 days. 14 days. How much is the 14 days? 2 weeks. So it takes you 2 weeks more to sell your inventory. Sometimes that's how you should present the information to the users' financial statements. Tell them how many weeks, rather than tell them 14 days. 14 days is just a number. 2 weeks, I can feel it. Before you can sell your inventory 2 weeks faster. Now take you 2 weeks more. The other thing is that to emphasize the numbers, you can say you spending half a month takes you half of month more to sell inventory. Now you say, oh my God, half a month, that's a lot. It's a 14 days, isn't it? So always present the information to the users in a way that they're gonna feel it. They can feel that number. Okay, that's with inventory turnover. Again, what we need the cost of goods sold, and we need the average inventory. Beginning, plus the ending divided by 2. Once you get the number, 365 become your numerator, inventory turnover denominator, and you get the number of days to sell your inventory. Accounts payable, same idea, but different information. What's the information here? We're chasing credit purchases, the purchases that we're getting, but we're not paying. And we're chasing the average accounts payable, which is the, again, beginning balance plus the ending balance divided by 2. Once we get that number, using it as a formula, as a denominator on 365 on the top, and we're calculating how many days took us to pay our accounts payable. That will give us number, and then we can check the company policy and how many days the company usually pays accounts payable. If the company pays accounts payable in 30 days, but this number suddenly shows it 45 days, that means you're not following your payment policy. So how is this company doing? Before we see that, again, the same idea like before. High number, less day to pay. Low number, more day takes you to pay. Imagine you're a vendor. You're selling this company materials on account. What do you want? You want your money faster. So what you're seeing in this company? You're seeing that accounts payable turnover start getting lower. That means this company losing their ability to pay faster. Again, increases 2 weeks on average. So let's see with the turnover, let's put it together again. As you can see, high number, less days. Less number, lower number, more days. What do you prefer, to get paid in 41 days or to get paid in 56 days?
21.
In 41.
I would prefer to be paid in every second week, right? That's even better. So that's with the three ratios. Three ratios. I want you to know them very well. Which ratio is going to come? It doesn't matter. If you know how to deal with those one, then you're safe. Solvency ratio. Let's see the solvency ratio. We start with the solvency ratio in the class. That shows you what's the level of debt compared to the total assets that the company has. And we're going to express it as a percentage of a total, percentage of a total capitalization. That will be the liability plus equity altogether. And the last one is the interest coverage ratio, which going to tells you how many times with your income you can pay the cost of the debt. So let's see first one. We're going to have simple net debt versus shareholders' equity. Only the shareholders' equity. Here we're chasing the proportion between liability and equity. Then you're going to see what's the net debt compared to the total debt plus equity, which is debt plus equity again represents the assets. That will give you the total portion of the financial financing represented by the debt. Once you get, let's see this company, first the debt to equity ratio. As you can see, the debt start increasing. Is that good for the company or bad for the company? At this point, we better don't say anything. Why? Because we need more information. Next one, we're seeing that this net debt compared to the total shareholders' equity plus the net debt also increasing. Right. So you see here, you have the number of the debt as a numerator, but you have it as a denominator as well, in combination with the rest of the on the other side. So basically here on this formula, you have the equity plus debt. So debt divided by equity plus debt. And see what's the percentage of that debt compared to the total capital of the company. And the last thing that you have to compare is the interest coverage ratio. Again, how many times you can pay your interest expenses from the borrowing, because that's what you're paying for. Interest expenses are related to the borrowings, with your income before interest, taxes, depreciation, and amortization. So now we can see interesting thing in this company. Before, with the income, they can pay their financial cost 13 times. But now they can pay their interest with the income 15 times, almost 16 times. The question is that good for the company? Well, let's check something. Let's see here. Where is my debt to equity ratio? Let's compare those two tables and let's think about it. When my debt is only, no, that's different. Earning before, no, that's not what I want. Sorry, what I was just, yes. When my debt represents 42% and the other 58% are equity, I can pay with my income before interest and taxes, I can pay my financial cost 13.6 times. Now, when my debt increase to almost 60%, I'm in better position. Why? Because I'm generating more income. And now I can pay my interest expenses almost 16 times. As you can see, the portion of the financial cost hasn't increased that much. What that means? That means we have access to the cheap debt, which we can use to generate our ideas, to generate the income, pay the interest, and more left for us. Which one is better, to pay you interest 13 times or to pay you interest 15 times?
13?
Which one, 13 or 15?
15.
15, of course. Because
Because we,
at this stage, you can pay it 13 times plus 2 more. So do you understand this?
Yes, yes,
Yeah.
yes, I do.
Right? So this number here, in this number here, 1470, we have 15.7 times, almost 16 times this 94. So I can pay 16 times my interest expenses.
so Professor, basically this debt to equity ratio says that if we are starting a company, so we will be like taking more debt than utilizing our own money. So
Well,
it's
as we can see,
the ratios, yeah,
right? As we can see here, the debt increasing, right? We
because
increase,
the debt is like so
right?
the
But
ratio should be how we'll be like looking while making
but
this.
right, but
We have to use
we cannot say. So the simple thing that we can say is it okay, this company, that they borrow more money? At this
yeah.
point, it's
So
okay,
how we'll analyze this? Because
right? That's what we're doing right now. The debt going up,
yeah,
but now they can pay the debt expenses 15 times or almost 16 times compared to where they were before. So is the debt problem for this company? Obviously not. They generating
so
earnings,
basically we need to see how it's work. Then we'll
right?
by calculating only we can decide whether to use debt more or equity.
Correct. So if I see this number now, if I see from 13, that number, once I'm increasing my debt, this number start going down, that means I should stop borrowing or reduce my borrowings so I can eliminate the interest expense. But right now I'm earning more with the more debt rather than, and if I have less debt, I'm earning less. Make sense?
Okay.
Do you see that?
Yeah, that's it.
So but technically, with the more debt, I'm earning $186,000 more. Where with the less debt, I'm earning only 1,980.
So basically, we have to do analysis saying different years.
Yes,
Yeah.
yes.
Okay.
Don't always look at those ratios together. Don't look only debt to equity ratio. Always check the
Okay.
interest coverage. Look
Okay.
at right. Those two ratio you have to look at together. If this goes up, but this goes also up, you don't have to
Mhm.
worry about it. Because definitely these people know how to use the debt. It's a cheap debt, they pay less expenses, and they're generating income.
Mm.
But if you see now at some point that these numbers start increasing and these numbers start going down, then that's
Then
concern.
there is a problem.
Then it's a problem.
So when we have to look in this both, and because it
Yes.
comes, it's a in relationship. So
Yes.
like the other relationships we're talking, we have to see both while making the decision for financial.
Correct. Correct. Always don't look at one ratio and say and make a conclusion.
Okay. Okay.
Look at the whole picture. Right?
Okay. The way you are analyzing, like they are interconnected with those,
right.
like if debt to equity comes, then we have to think about interest coverage.
Correct.
Okay.
Correct. Correct. Same thing like let's say we're doctors and the patient comes and say, I have a high fever. And the conclusion that we can make is, oh, you're due for surgery,
Mm,
right?
yeah.
Mm,
Thank you.
it's not really, right? We have to look at other things. We check one thing, now let's look at the other things. Once we find all the symptoms, then we can talk. So now let's see those are the three ratios. So those are the ratios that we need to know about the leverage and the solvency. Solvency. Now let's look at the profitability ratio. Profitability ratio, first ratio will be the gross margin, which tells you how much company generates purely only from the main operation. Profit margin is going to tell you how much company generate once we put the cost of the doing business. Then we're going to see a return on equity and then return on the assets. Obviously, in all those formulas, in the first formulas at least, in the beginning, we're going to play with the sales. So how much is the gross margin as a percentage of sales? How much is the profit margin as a percentage of sales? Once we calculate this return on equity, we're always going to see how much is my profit generating from the money that I invest, and how much profit I'm generating from the assets that I using. So let's see the first one. Again, gross margin is simply tells you how much company generate from the main purpose of the business. That's why in the gross margin is calculated by simply having sales minus cost of goods sold. And that's going to give you always gross margin. So I'm chasing how much I'm generating from the main purpose that I open my business. So the other way is how much from every dollar of sales take me to pay the cost of that sales and stay with me. Next thing that we have to chase is once I get the gross margin, we're going to calculate the next, which is the profit margin. profit margin will be equal to the net income now. How much is the net income out of sales? Or once we have sales minus cost of goods sold minus the operating expenses. Or the profit margin will be gross margin minus the operating expenses. And that's going to give you now profit margin, or going to give you the operating income or net income in this case. And now you're going to express the net income as a percentage of sales. Let's see how this company perform. First, gross margin. For every dollar of sales, 21 cents, 22 cents almost, stay with them. What's happened with the rest? 78%. That's how much cost them the inventory that they're selling. Make sense?
Yes, it does.
Now, but this is only and only to generate that sales. Now, let's see what's going to happen if we're adding the operating expenses. Once we're adding the operating expenses, that we can see that for every dollar of sales, this company generate only 4.4 cents. So what's happened with the other 95 cents? Well, we already saw 78 cents goes to the cost of goods sold, the rest going to the operating expenses. Does that make sense now? Do you understand that the gross margin always going to be high percentage? It has to be. There's no way gross margin to be lower than the profit margin. Profit margin is the lowest one, the lowest possible number. Why the lowest possible? Because that's what's left in the company. Nothing more, nothing less. Let me see if I can find it on the first, very first one, they're introducing the information here. But they don't have, here they don't have, or maybe we can see it here. Okay, can you guys see my screen?
Yes, I can.
Yes, Professor.
Okay,
we can
so
see.
watch this. This is our revenue. Our operating cost is that much. That's how much left. Once we're deducting everything else, net earnings is only 625. Now at this point, I don't know if they're using this number as a cost of goods sold, and they come up with this. Probably not, because that's too small number. But that's how it is. The revenue, then you have cost of goods sold, then you're getting the first percentage, 22%, and then you're checking, go, and then you're gonna see the net earnings, where net earnings is, in this case, will be 4.4%. Justification on those for 4% should be, you're getting here 625. Let's see if that's gonna match. 625 divided by 142.93. 4.4%. I'm not sure if a 1.70 divided by 142.93 is going to give you the, no, it's not very. So that means this is not cost of goods sold. This number is not cost of goods sold. This number is too high. We need more here. So in this information here, we don't see the gross margin. We only can calculate the profit margin here. For the gross margin, we need different information. That's how we should interpret those numbers. Let's keep going with those equity earnings ratios. Next one is return on equity. Return on equity will be the net income that company generate minus if there are any dividend that they have to pay on the preferred shares, divided by the average equity, which is the average equity will be the beginning of the year plus the ending divided by 2. So for every dollar that this company, the shareholders invested, they're gonna get 10 cents for every dollar that they're investing. That's their return. Now, what's the return on the assets? Now, obviously, return on equity will be higher than return on the assets. Why? Because as you remember, on the accounting formula, assets equal to liability plus equity. Assets are liability plus equity altogether. So that's why return on equity is only net income divided by the portion of the equity and equity only, which is less than the assets altogether. So eliminating the debt here and see how much belongs only to the owners. And a return on the assets is with the assets that we have through the entire year, which is the average assets, beginning of the year versus end of the year divided by 2, how much net income we're generating. And that means for every dollar of asset, we're generating 5 cents. We used to make 8 cents, but now that return on the assets start going down. One of the reasons, as you simply can see, is the number of the assets start going up. Let's see the equity analysis ratio, which is the earnings per share. Earnings per share, the investors are very sensitive on that ratio. Why? Because they want to know for every share that I have, how much of the net income I can get. There are two types of earnings per share. Will be one is the basic earnings per share, the other one is diluted earnings per share. Diluted earnings per share is obviously that will be a lower number than the basic earnings per share. Basic earnings per share is high number. Diluted earnings per share is lower number because that number simply increasing the denominator. Once you increase the weighted average number of the outstanding shares, you're naturally decreasing the result. We're not going to spend time here how to calculate the weighted average number of common shares, but you have to understand this. It's not like a simple average. It's a weighted average based on the how many days or how many months those shares were actually outstanding. And what's the proportion of those months compared to the entire year. This company, as you can see, the basic earning per share is higher, 1.6, and the diluted is lower, 1.5. Here, the same thing in 2021, 153 versus 152. Remember, always diluted earnings per share is lower than the earnings per share, but the diluted earnings per share, that's a hypothetical number. More stable number is earnings per share. Next ratio to see how the company performs is the price earning ratio, which shows you the market price of the shares versus how much income you're getting per one share. Obviously, you want to know that ratio. That's also called belief yield. So that means that if the market price is, as you can see, the market price of the shares start going down compared to the earnings per shares. So earnings per share goes down, market price also goes down. Follow right away. So in the year that you have the lowest earnings per share, market price adjusted. Once the earnings per share start increasing, the market price also increasing. Market follows the the earnings per share number. Usually, not necessarily. There might be other things that can drive the market price. The one thing that you should remember is the market is very sensitive, so we cannot make a simple conclusion how the market's going to react. We have to wait sometimes and see what's going to happen. For example, if you have tried to convert, let's say, $1,000 a week ago, 1,000 Canadian, for 1,000 Canadian, you'll be able to get, no, actually, if you want to get, how was it? If you want to get 1,000 1,000 US dollars today, you have to give 1,500 Canadian. 1 week ago, you have to give 1,450 Canadian. So now it costs you $50 more to get the same amount of US dollars. That's how the market reacts, based on the simple fact that February 1st, Donald Trump will eliminate that tariff for 25% with Canada. And you can see the foreign exchange market adjusted right away. Now, how this is going to affect, how this is going to stay? Is it going to stay on the long term? We have to wait and see. Because on the other hand, Bank of Canada reduced the interest rate. Well, obviously, that's not going to be too in favor of Canadian dollars. Why? Because the investors, the one that waiting only for the interest, they're going to get out of Canada right away. Why? Because Canada doesn't give them high interest rate anymore. On the other hand, it's now when we're dealing with the US, if you have a business which can borrow cheap money now in Canada, but has to get all the or transport all the goods back to US, now would be subject for 25. So make everything more expensive. So in that case, you're gonna wonder, why should I buy from Canada at all? It's gonna be very interesting, but that's how market reacts. So you have to understand, with those analysis, you have to consider the entire environment as well. Let's see the dividend payout. Dividend per share versus the earnings per share. That's also interesting ratio. How much dividend per share you can get versus how much earnings per share you can get. That will be, now the dividend is that the company pays, as you can see, from 66 cents increase to 70 cents. But earnings per share is from $2 almost to 1.53. So what that means is that out of potential $1.53 that comes to my retained earnings, I'm giving to the shareholders only 70 cents, or 45% of every dollar. For every dollar that the company generates as income, I'm giving to the shareholders only 46 cents. The other 54 cents, I keep it in the company. That's how you should interpret this ratio. Dividends, obviously, why the company doesn't give the shareholders 100% of the earnings? Maybe because the company wants to preserve the retained earnings for something that they want to invest in the future. So the question is, what do you want? Do you want a dividend now, or you want me to increase the market price of the shares for every share that you have? What will be more beneficial for you? To get 70 cents now per share, or to increase the market price per share with let's say $10?
Increase it, the market price.
Right.
Yeah.
But in order to increase the market price, I have to preserve my net income, keep it in the company as retained earnings, don't give the cash away, and invest in the more profitable projects, which are going to increase the market value of the shares. But people always preferred cash in the hand rather than something in the future, right? That will be the rationality here. Dividend yield will be the dividend per share divided by the price per share. That will be the measure the dividend will receive relative to the price per share. So how much, if I pay that much, how much is going to come back to me as a dividend? So in this case, for every dollar that I'm paying, I'm going to get 2 cents or 1.85. So if the dividend that the company declares is 70 cents per share and the market price is 37.79, you're getting 2% return for every dollar that you invest in a company as a dividend. Again, don't forget, this is only as a dividend. If the market price increase, then that's a different story. So let's say here, I own one share of this company. I'm paying $38 for that share. What can I expect? I can expect 70 cents back to me, which is transferred to 2% of the price that I pay for the shares. And what else I can expect? I can expect the market price to goes up. Which one will be I will be relying more on 2% return as a dividend or increase in the market price? You can easily guess here. Then we have this equity analysis. That will be the free cash. What is the free cash? Free cash is the cash from operations, operating activities from the cash flow, minus all the capital expenditures, which you using to have ability to generate more return in the future, and minus the preferred shares, dividend that you're paying to the preferred shares. Now, what are everything that has a benefits has limitations. Which are the limitations on the ratios? First, you have to know very well the accounting policies that the company is using. Well, where you're going to see those accounting policy? Obviously, notes to financial statements. Once you see the notes of financial statements, so you have to read the information, you have to interpret the information the proper way. You have to understand the definitions of the ratios and what's in the ratio. As you can see, you cannot just look at the ratio, it's not a standalone ratio. You always have to do it in the combination of the other ratios. Diversity of the operations, how diversified the company is. Is this a seasonal business or the all year round? And what's the potential of the manipulation? Because sometimes the prepare financial reports or the management prepare reports for the specific purpose, and that purpose might be to make the company less attractive to investors. How can we use the non-international financial reporting financial measures? Well, example of the non-financial reporting standards financial measures are the free cash that we see the last formula, earning before interest, taxes, depreciation, and amortization. That's another term which is not used by international financial reporting standards. Net debt, debt to equity, net debt as a percentage of the total capitalization, interest coverage ratio is not part, and the net free cash flows, those are the one which are not used. When you're using those one, you have to be cautious. And there's no standard definition for those measures. So then you are free to do any interpretation that you might find useful. The measurement that you measure those numbers usually not comparable across all the companies, because not all the companies are presenting the information the same way. So you can calculate those one and to be used as a common size analysis for common size analysis or cross analysis. Information is used to determine the measures. It might be not be audited, so be careful with that one. So there's no verification of the final numbers. And that's the end of this chapter. Again, once you see the question and you see the information on the question, can you guys see my screen?
Yes, I can. Sorry, my
Yes, Professor.
mic was muted.
Oh, I see. Sorry. So once you see the question and you see, okay, I have the annual sales and accounts receivables. Is it possible for me to calculate inventory turnover?
No.
No. Is it possible
No,
for me to is it possible for you to get the accounts payable?
Not payable.
Not payable.
it will be possible.
Can you just give me a second? Just a second. I want to check something. Obviously, we have to calculate accounts receivable turnover. Now,
Yes.
accounts receivable turnover. Can I get, so obviously, let's say this is year, let's say I have 2 years. I have year 2022 and year 2021. If I have 2 reports, and if this is year, all this information that I have is for year 2022, which will be the ending balance for the 2022, and which will be the ending balance for 2021? What do you think?
Ending balance for 2021 will be 8170. And opening balance for 22 would be 8170. Closing balance for 22 would be 5760.
So now the January 1st is 2022. And then let's say December 2022. So in this case, which one is the ending balance for 2022 and ending balance for 2021?
Opening will be 5,760 and the ending will be 8,170.
So what that means is the ending balance for 2022 will be
The opening balance.
8170, and the ending balance for 2021 will be 5760. Is that what you're saying?
Yes.
Yes. Why is that? Let's think about it.
December.
So in what's the, let's say we are year 2021. What's the ending date of the year?
December 30th.
December 31st, right? What time?
Midnight?
2021.
11:59.
11:59 p.m. Right? So now the question is, this is the end of the year end.
Yeah.
Where is the start of the new year?
First of
January
January.
1st,
2021,
2022.
2022. Obviously, it has to be January 1st. What time?
12 o'clock.
00:00 a.m. Make sense?
Yes.
Yeah.
That will be the start
Yeah.
of the year. Year start. Okay. We know that, right? So this is my ending balance at year 2021. Make sense? And this is my beginning balance for the year 2022. What are the chances the ending balance for 2021 to be different than the beginning balance in 2022? What do you think?
It's a low
No,
possibility.
no chance.
No chance at all, right? Because how distance is ending balance from the beginning balance? It's 1 second. Can you see it?
Yeah.
So that's
Yes.
how distant is one reporting period to the other reporting period. That's why in accounting we say the ending balance is equal to the beginning balance. Make sense? So
Yes.
that's why sometimes the question here is going to give you receivables at December 31st, 2021 is that much. Or they can give you the way there was January 1st, December 31st. Make sense? I want you to understand that December 31st and January 1st are used interchangeably, but they mean exactly the same thing. Make sense?
Yes, Professor.
Okay. So if this is the way you're giving the information, which one is the beginning balance for 2022? If the information is presented this way, which one is the beginning balance for 2022?
Should be the 5760
5,000.
Okay.
from
What's the ending balance for 2022?
8170.
Okay. How about the other company? We have 2022 and 2021. What's the beginning balance? What's the ending balance in 2021? What's the number that I have to put here? 1620, right?
1620.
How about here? 2080.
Mm.
Okay, so how can I calculate the accounts receivable turnover? I have to get the credit sales divided by average accounts receivables, correct?
Yes.
Okay, so my accounts receivable turnover here will be equal to, what's my credit sales? Here the question says the calculate accounts receivables turnover for each company, assuming that all the sales are on account. So basically we're not getting any cash though. So here my number will be directly the annual sales. What will be my denominator now? That will be the beginning balance, which is 5760 plus ending
The
balance,
ending
which
balance.
is 8.170 divided by 2. Correct?
6965 down.
Right? So now let's do the calculation. What we're going to get here? Here will be the same number, right? There's no difference. For the other one, there will be changes. Now we're going to get equal to this one plus that one divided by 2. Is that what you're getting?
Is your credit sales for the next company not different?
Same?
The credit sales
What do you mean?
for the second company.
Instead of the 60,000,
You've got
should be
60,600. It should be
29,760 under
Let's see.
the
This one,
other
This
enterprise.
one is for Ivanhoe Foods Company, right?
Ivanhoe, yes. That's for the Ivanhoe company. Yes, that's what we're doing. We're
Yes.
doing Ivanhoe company. We're getting the
Yes.
beginning balance plus the ending balance divided by 2. And
Oh,
this
sorry,
is,
that's the calculated amount yet. Sorry.
yeah. Make sense?
Yes.
Yes,
thanks.
So
Professor.
now the question is, what's the accounts receivable turnover? It's going to be this number divided by that number.
8.70, yes.
Is that what you're getting?
Yes.
Everybody get that number. Okay, let's go with the next one. Next one, we have to get the accounts receivable for the next company, right? Next company, what they gonna have? Their sales are 29,760.
29,000.
Denominator, we're gonna have 1620 plus 2.080 divided by 2. And once we get those numbers, we're gonna have this one here, and that will be equal to this one plus that one in brackets divided by 2. Let's put the bracket in the beginning, and we're done. So my calculation here will be, so which company has a better number? And which company has better number here? Which company you want to be, in the first one or the second one? What you gonna say?
The second one, the
16.09.
16.09.
Right? So let's see how this is gonna transfer to what's the next thing that we have to calculate.
The average collection period.
Average collection period. In terms of days, right? Here we're chasing how many days? Nothing more, nothing less. So let's go with the first company. Let's stay with the blue here. First company, what they have? How are we going to get this collection date? On the
365
we're going to 365 days divided by
divided by
accounts
account
receivable turnover.
receivable turnover.
Right? We need those two numbers. Once we get 365 here, then we're going to get this number from here for the first company. And what we're going to get, our number here will be this one divided by that one. Let's stay with below. What's the 41.95? What's that for us?
Days.
Days. Make sense? That's how many days takes us to collect our accounts receivables. What will be where will be the second company then? Is it going to be the same or better?
Same.
It will be better.
Formula is the same.
Formula will be the same. Yeah, no, formula will be the same. No questions about it. Let's put it in the.
Days will be less.
65 divided by 16.09.
Okay, so let's get this this one here. Let's get see that will be V and V. Formula will be the same. There will be no changes in the formula, but
Account turn.
right, accounts receivable turnover, and then we're gonna have 365 again here divided by 16.09, and that's gonna give us
22.68. Yeah.
days. So let's highlight it in different colors so you can see it. Not this one, sorry. That will stay automatic. We're gonna highlight this one in this color. So which company is better?
Second one.
The second one.
Second one. Why? Because first, the accounts receivable turnover is higher.
Yeah.
And days to
The
collect
days
account
collection is less. Sorry.
less. What you gonna suggest the first company to do?
To increase their
How
account.
can improve the accounts receivables? Give me ideas. You're the managers. Tell them what to do. I have a problem with accounts receivables, obviously. What should they do?
Collecting their checks early.
How? What should they do?
Sell more products proactively and increase
Selling
increase
in
your sales.
not in credit,
How the
credit,
sales?
but in cash or
Yeah. Okay. Selling in cash. Okay. Selling in cash. Good. What else?
mm,
Be more strict with your accounts payable, as in accounts receivable. As
Okay.
in put in set terms and make people stick with it.
Okay. So what should I do? How can I be more strict? Be specific now. You're on the right track. Be more specific now.
mm,
How can we be more strict? Give me ideas, people. I want you to think.
Maybe impose a specific date on like how much days should
Okay.
the supplier or so you have to receive the payment that for out of your from your service that you have already provided, like
Okay.
certain dates and days.
Okay. Somebody's thinking now. Okay. Keep going. What else?
And also, if they don't skip to the specified dates you've given them, you don't sell further to them, so as not to keep accumulating.
Okay. Good. Good suggestions. Straighten your account receivable policy. Do the background credit check on your new customers. Everything that you can do. That's where I want you to be. I want you to be on the preventive side. Once you see the numbers, to tell them what to do and to fix their problem. Now let's see the next question. Next question is related now to the inventory turnover. For the inventory turnover, what do we need? Cost of goods sold and the inventory beginning and ending balance. So let's see. The ending balance for 2022 for the first company. What is it? $681,600. Ending balance for 2021 will be $755,300. Correct? Are you guys with me? Can you see my screen?
Yes,
Yes.
Professor.
So the next company. What shall we do with the next company? Give me the ending balance for 2022.
So 1,000,000.
Ending is
681,600 plus
So that will be
755,200 divided
so
by
that
2.
will be no here on this company. That will be ending balance
Oh.
will be 1027.
ending 102
Yeah.
side. Yeah. The beginning will be 5095500.
Okay, perfect. So now accounts inventory turnover. How are we gonna get it? Cost of goods sold
Cost of goods sold.
divided by average inventory.
Agreed.
How much is my cost of goods sold?
10776 and
For
This one.
first
For the first company is that much.
so,
Denominator
and
will
the
be
755
55.300 plus
plus 681
681
600
600 divided by 2.
divided by 2.
Okay, let's calculate it now. This number here, this number here will be bracket this one plus that one divided by 2. We get it. So what you're getting here is a number. 15, is that what you're getting? Okay, how many days they take them to sell the inventory? How are we gonna get this number? 365 divided by the number just we get, correct?
Yes.
So
Divided by
365,
15.
right? Divided by this number. And what we're gonna get here?
24.33.
24.3. What is that? Days
Days.
to sell.
number of days, how fast you can sell your inventory.
Right. 24 days take this company to sell the inventory. How about the other company? Same idea. Get the cost of goods sold.
Yes.
Get the inventory. 5095 500 plus 1027 comma 123. So that will be 200 here divided by 2. And this one will be equal to that number. And this one will be equal to beginning balance plus ending balance bracket divided by 2. Let's put the bracket at the beginning. And we get the number. So what will be our number here? This one divided by this number is going to give us 16.3. Is this company going to be better than the first one in
No,
terms of
because
day to sell? What's
no.
happened with the number? Think about it. Inventory goes up, turnover goes up. What's going to happen with the
Based
days?
on it.
Days for sales going to
They
go,
sell.
It will be better because the sales to
right?
turnover is
What we chasing here? We're chasing high number.
We-
Remember, high
yeah
number is going to
the
bring the next
more
one. Right.
Yeah.
So if we plug this number here and here, what we're going to get? 365,
no sir
What?
here will be 24.22.
22.4. And that will be our days to sales. So which company sells faster?
Sir, you can
The
okay,
second one.
Second one.
The second one will be better.
Now think about it now. Which business we are? Fresh fruits.
Yes.
24 days selling your fresh fruits. Are you going to be okay? Are you going to
No.
invest?
I don't think so.
No.
No. 24 days, that's too much, right? Imagine your oranges sitting 24 days.
It's a bad no.
But no. That's 3.5 weeks. You cannot sell your oranges.
Yeah.
How about the other company? It's a supermarket.
Yeah, so it depends on the supermarket. They are not like fresh, and
So-
even the fees for selling their inventory is lesser
What
than
kind
the
of
fresh
so
fruit.
okay? What kind of food they should sell? If they
In
stay
supermarket,
in supermarket, what kind of food?
they
Packages.
may be selling packages food
So yes,
products.
packages food, frozen food, anything like that.
Yeah, and they have longer lifestyle than the
Right.
fresh food.
Okay, make sense?
Yeah.
So that's where I want you to be. Once you see the business, to think, is this good number? You calculate the number, they tell me, is that a good number? If I'm in the bakery business, 24.3, would you buy my cake?
No.
Never,
No.
never, never will not buy it because it needs to be
Right.
sold freshly.
How about if I'm the fresh flower business? Would you buy my flowers?
No.
No.
No,
Maybe dry
unless
flower are those dry
yeah.
flowers?
So basically, professor, we are making like you are giving two companies, so we have to look at the nature of the companies too.
It's
By
gonna be it's gonna be one company. So what I want you to do is you to provide the like a recommendation,
Analysis, yeah.
analyze the
Okay.
information. So basically, yes, you still have to calculate those numbers, but
Mhm.
the calculation of the number is not gonna help you unless you understand the business.
Okay.
Make sense? What's the value for you to get me 24.3 and your job is done? And okay, I can calculate days to sell inventory. So what?
Yeah, we have to make decision as per the
Right.
yeah, okay.
Make sense?
Yeah, professor.
Yes,
I don't want
Professor.
you for the calculation. I want you for the interpretation of the number.
So even if like for example, we have calculated this calculation, but instead of that, the fresh market, the company would have been like manufacturing or car business or land. Then
Yeah.
so we have to decide as per that business
Right.
nature. Okay.
Yes.
So
yes.
we have to select. Oh, okay.
You have to decide based on the business that the company is in, is that a good number or not good number? So either provide recommendation. So if you see this one on the fresh fruits business,
Mhm.
what will be your recommendation? What they should do? We all agree this is a bad number. So what should they do? What you gonna recommend them to do?
I think I would suggest that
To-
they buy if they sell in lesser quantity and finish it up on time, and then get a fresh one and then sell on time. And, you know.
No,
Yeah.
but how? How? I'm not
They
selling.
Maybe do a more productive way to promote their products so they can
How?
sell it.
How?
They can provide discount
Discount, okay? What else?
or
What the other store? What the store's doing? You shopping
Bulk
from the store.
buying.
Bulk buying, okay, great, right?
Okay.
If you buy one, it's gonna cost you $5. But if you buy two,
Yeah.
$6,
Like promotional activities we can to
right?
increase their sales.
Make sense? That's why we have weekly
Okay.
promotion. I have weekly promotion. Which products I'm promoting? The one that are slow, I have. That's why I'm monitoring those days to sell my inventory. And the products that have a slow inventory, days
Yeah,
to
they
sell
can
my,
also
right?
focus
That's,
on the flower which are in
yeah,
more in demand and that
exactly.
season.
That's why I need that inventory turnover. I need that number every day. So I know on which next week, which product I should put on sale. And what I,
Okay.
right?
Got it, Professor. Yeah.
And,
So
and
the
usually,
exact the quiz will be somehow similar to this one.
yeah.
Like we have to. Okay,
Yeah.
got it.
And the other thing is okay, if you see that if you see the sales, pay attention when you go to the stores. Pay attention which products are on sale. Once the product is on sale, check the expiry date,
Yeah, we
and
always
right, and then you're gonna see
Exactly. Yeah.
why the product is on sale,
yeah, because they want to finish their inventory faster.
right?
Okay. So, Professor, I have one question.
Yes,
So, as per this, so we calculated this, but the days to sell inventory is in the company supermarket is later, but we are focusing on the fresh fruit. So we even the days to sell inventory is later uh,
still not good.
than comparison to the fresh market, but we are focusing more on the fresh market. So we have even so we have to find give the reasons as per their company's nature, not by looking like we have calculated this, but the days to sell inventory is lower in this, so we'll be selecting. Not like that, right?
Not like that, no.
Oh, I
Right?
understood
So
now.
so even
Okay.
but I'm not going to challenge you that, but you're on the right track. That's what I want you to see. Yes, you can say you can in this case, yeah, you can say, well, the second company is way better than the first one, but
Yeah.
still worse,
Mm,
right? 2 days faster selling the fresh fruits. That doesn't change the picture dramatically. I want this grocery to supermarket to have those items on sale for like a week, 2 weeks max. We're pushing here 3 weeks and above. That's too much. Imagine if you're selling the fresh meat.
okay.
What's gonna happen with the meat if you cannot sell it in 3 and more weeks?
Eventually.
On the third day, you can throw it away. Some of
Yeah.
the meat on the second day, you just
Profit
throw it away.
loss.
Yeah, yeah. You can
Mm,
sometimes you can see you cook the food, you forget it on the oven or on the stove next day, so you have to throw it away,
yeah.
right?
Okay, Professor.
Okay. Now makes more sense, right?